The sign on the branch door still gleamed in the morning light, but the windows were the color of doubt. A line of customers bent like a riverbank around the corner. Their silence had weight. They clutched paper statements and plastic cards in a kind of modern prayer, the hope that numbers on a screen would become cash in hand. In the distance, sirens stitched through the fabric of the city, and the oldest story in finance slowly uncoiled. When a bank fails, a town loses more than a building. It loses a heartbeat. The question is posed with chilling simplicity. Should banks be allowed to fail? The history is anything but simple. Banks manufacture the very oxygen of commerce. Credit is not a hose connected to a pre-existing pool. It is the pool filled each time a bank writes a loan and records a matching deposit. Economists like Richard Werner have argued for decades that the vast majority of money in circulation is not minted by treasuries, but typed into existence by banks, a form of bank digital currency that makes up roughly 97% of the money supply. When that system breaks, it is not just a firm that falters, it is the supply of money to households, to small businesses, to payrolls, to tomorrow's grocery list. Shrink the money supply, and economies contract like lungs in cold water. The 1930s wrote this lesson in frost. The United States watched as roughly 10,000 small banks vanished, like lights in a storm. Milton Friedman and Anna Schwartz chronicled how the Federal Reserve failed to act as a true lender of last resort. Ben Bernanke, years later, would publicly acknowledge their insight. The effect was not a market correction. It was mass unemployment, dust on dinner plates, and the sight of parents quietly selling their wedding rings. That is what a failed banking system looks like at street level. Not a theory, a pantry. Everything inside a banking system is connected. Banks are not isolated storefronts. They are nodes in a nervous system. The technical word is contagion, but the lived experience is closer to a whisper that becomes a shout. Deposit withdrawals at one institution can force liquidations of assets, which mark other balance sheets to new and lower prices, which feeds panic. A healthy bank with sound loans can be toppled by the psychology of coordination failure. Douglas Diamond and Philip Dybvig formalized this in the 1980s, but the parable is older than Bagehot's bowler hat. If enough depositors run, even a sturdy bank will trip. Reputation is the shadow that finance casts. When a bank collapses, trust ricochets through the currency, the money markets, and the quiet places where savers keep their fears. Some sell national currency. Others reach for gold bars like talismans or for private cryptocurrencies that promise a sovereignty the world rarely delivers. Monetary policy ceases to be a steering wheel and becomes a rumor. The effect is most tragic among the most valuable institutions of all. The local banks that understand which bakery will thrive and which welder is worth a line of credit. They are as rooted as oaks and as vulnerable as saplings in a gale. There is also the naked question of fairness. A system that asks every citizen to choose among complex risk profiles while requiring each of them to bank is not a marketplace. It is a maze. The speculator who shorts bank equity may harvest profits with the same speed that ordinary depositors watch legally unsecured balances evaporate above the insured threshold. Insurance exists, but it is finite and numeric, and fear has a way of finding the gap between a guarantee and a payroll due on Monday. The design flaw is old, and it is not a moral failing. It is structural. A bank can be perfectly solvent on paper and still succumb to a sudden demand for deposits. Walter Bagehot offered the antidote in the 19th century. In a panic, lend freely, against good collateral, at a penalty rate. The principle is simple. The execution is everything. In the early 1930s, the principle was honored in the breach. In 1933, deposit insurance was introduced, and with it, the promise that failures would not become famine. Yet the memory of that decade still paces like a hungry dog outside modern policy debates. There's a counter-argument that says bailouts defy free enterprise, but introduce a central bank, and one has already left the naked market for a world of umpires and rules. Bureaucracies expand. The literature on bureaucratic drift reads like a botany manual for ivy. Central planning grows where stone allows it to cling. The United States functioned for long stretches without a central bank. Growth then was volatile and often high, and the banking sector was diverse to the point of chaos. Today, the nation's economy still benefits from large numbers of community banks, yet the long arc has bent toward concentration. Diversity in banking is not a sentimental preference. It is industrial policy and work boots. In Germany, thousands of savings, banks, and cooperative lenders underwrote generations of middle-stand firms that built machine tools and specialty chemicals and exported them with a quiet ferocity. In the United States, town banks financed farms, diners, roofers, and the first trucks owned by the people who would one day own fleets. Where there are many banks, there are many judgments about creditworthiness, and many paths for ambition to become cash flow. Consolidation narrows the lens. Fewer, larger institutions prefer standardized underwriting and collateral that is easy to sell. That can mean less funding for small firms that make actual goods and more credit creation for the purchase of assets like real estate or equities. The former builds employment and real output. The latter builds bubbles and the stories people tell themselves while prices rise. Hyman Minsky warned that stability breeds instability, long runs of calm finance fragility. Concentrated banking systems amplify the swing. The modern episode in this old saga came on a cool morning in March of the year 2023. Silicon Valley Bank lost almost $50 billion of deposits in a single day. The run moved at the speed of a group chat. Corporate treasurers who had never stood in a teller line watched dashboards bleed. The bank held long-dated securities whose market value had fallen as interest rates rose. By the time the dust settled, supervisors had closed the doors. Signature Bank fell next. Only after closure did liquidity flood the pipes. The promised lender of last resort arrived like a fire brigade that waits for the building to collapse before turning on the hydrant. The technology was modern. The psychology was prehistoric. Loss aversion, cataloged by Daniel Kahneman and Amos Tversky, tells us that the pain of losing a dollar is greater than the pleasure of gaining one. Herding, well documented in finance, tells us that when the cost of standing alone is bankruptcy, even independent thinkers join the stampede. Social proof is not a buzzword in a panic. It is a survival strategy. The coordination game has only one equilibrium when the rumor mill starts grinding. Everyone runs. The policy question returns with the inevitability of tide. Allow failure and risk the contraction of the money supply, the contagion through balance sheets, the reputational crater, and the inequity to depositors who lack the time and tools to police banks. Prevent failure and risk moral hazard, the breeding of complacency, and the creeping power of bureaucracies that promise to extinguish fires while quietly building taller watchtowers. Richard Werner's answer is not to choose between chaos and control, but to grow the forest. More banks, not fewer. More local banks that know their borrowers by reputation and not solely by algorithm. The data are not romantic. Local banks lend more to small firms. Credit that finances production swells, employment, and expands supply, which relieves inflation rather than stoking it. Credit that finances asset purchases, raises valuations without lifting output, which inflates bubbles rather than wages. The composition of credit creation is destiny. The global stage provides a counterexample written in red banners and factory smoke. In 1978, Deng Xiaoping pushed aside a monolithic Soviet-style system and allowed thousands of banks, many of them local, to wake from the long sleep of central planning. He did not consult a treatise on perfect markets. He looked at what worked. 4 decades of rapid growth followed, uneven and controversial, but undeniable in scale and speed. One lesson is hard to ignore. Decentralized banking systems are shock absorbers. Centralized systems are single points of failure. The newest temptation in the old palace of control is the central bank digital currency. The pitch is polished. Faster settlements, financial inclusion, traceability that can hunt fraud across borders and time zones. The conflict of interest is blunt. If the referee becomes a player, what happens to the game? If deposits can migrate into liabilities of the central bank with a tap, then a frightened public may run not toward the nearest tall bank, but toward the tallest building in the capital. After one more crisis, deposits could drain from commercial banks and pool at the center. The world would wake to a single bank economy that looks efficient on a flowchart and suffocating on a street map. The metaphor writes itself, and it should be resisted. A referee scoring goals would be laughed out of the stadium. Yet a regulator competing with regulated institutions is spoken of as modernization. The risks are more than philosophical. Programmable money can be a scalpel for public goods or a leash for public lives. If the same institution sets the rules, monitors the play, and holds the accounts, the distance between policy and compulsion shrinks to a few lines of code. What, then, should be done when a bank staggers? The answer is surgical, not theatrical. First, distinguish solvency from liquidity. If assets are sound and cash is short, lend quickly and publicly against good collateral, exactly as Beige-Hot advised. Do it before the rumor becomes a verdict. Second, protect ordinary depositors while imposing real losses on management and owners who made reckless bets. That is not a bailout. That is the rule of capitalism applied with a steady hand. Third, widen the banking ecosystem. Charter new local banks with rigorous practical supervision. Diversity is a risk control, not a slogan. Fourth, update deposit insurance with intelligence rather than blunt force. Modern payment systems can preposition backstops that activate once boards declare extraordinary resolution. That keeps grocery stores open on Monday while examiners read the footnotes on Tuesday. Fifth, keep the referee out of the penalty box. If central banks wish to study digital cash, they should do so in a framework that walls off core deposits at commercial institutions from sudden, frictionless flight to the center. The purpose of a monetary authority is to keep the pipes clear, not to own all the faucets. The debate about allowing banks to fail is, at heart, a debate about what money should be, a promise made by a distant authority, a relationship between a lender and a town, a stream that irrigates fields or a flood that polishes stones and starves the soil beneath them. In the 1930s, a failure of nerve turned a recession into a calamity. In recent years, a failure of imagination almost turned a contained fire into a neighborhood blaze. Both episodes warn against abstractions that forget faces. Names anchor the record. Friedman and Schwartz on the mechanism of monetary collapse. Beige-Hot on the conduct of panics. Diamond and Dybvig on the logic of runs. Hyman Minsky on the geometry of stability and crisis. Daniel Kahneman and Amos Tversky on the unreliable narrator that lives in every human mind. And Richard Werner on the architecture of credit creation and the power of small, local banks to turn savings into livelihoods. The conclusion is sober. Banks should not be allowed to fail in a way that collapses the money supply, annihilates trust, and punishes those least equipped to see around corners. But banks should be allowed to fail in the way that capitalism requires, with equity and management bearing the brunt, with creditors absorbing risk according to law, and with depositors protected swiftly and mechanically. The path between these poles is narrow. It has always been narrow. It is the path that keeps commerce flowing in winter and hope alive in spring. A country that treasures both liberty and prosperity must choose institutions that do not crush the human spirit. Decentralized banking is not nostalgia. It is resilience. Many banks, many judgments, many hires, many inventions. The work of policy is to make that possible, to be lender of last resort when smoke fills the stairwell, and to refuse the crown that turns a steward into a sovereign. In the end, the test is simple enough for a child to grade. When a bank falls, does the town rise again? When the next rumor starts, do workers still get paid? When the years pass, are there more front doors with lights on? A banking system is a living thing. Allow it to prune failure without sawing through the trunk. Keep the soil loose and the roots diverse. Feed production before speculation. Lend to build, not to inflate. If that sounds like old wisdom, It is because the oldest truths in finance survive precisely because they carry a ledger of human consequence. The choice is not between chaos and control. The choice is between brittle order and living order. Choose the system that breathes.